Hello. In this discussion, I want to talk to you about the use of debt, basically, to finance companies and how you would figure out the cost of debt. So, first of all, just kind of talking about what debt is. I think most of us are familiar with it, but it's the money that a firm has borrowed. And so there's a lot of different ways they can borrow, but basically is how we borrowed the money, we expect to have to pay it back. Couple of key things to understand about debt as it relates to investing in a company. If you're the debt holder, so you're the person that is loaning money to the company, the most you can ever receive from the company back is whatever the contractually agreed payments are. Usually that's some interest and some principal. Um, if the company does well, you don't get to participate in any additional profits of the company. If the firm does badly and it makes a bad financial decision and so that it's unable to make your payments, then you may have the right to liquidate the company or liquidate some specific assets um, in order to pay your debts. And if you were to do that, if you were to liquidate some of your assets, maybe you just decided to shut the company down and liquidate it, maybe the debt holders didn't make you, then by law, you have to pay sure that you pay your debt holders off first before you can do anything else with the money you get from the liquidation. So, for example, you can't say, oh, we're having a bad time, we owe a whole bunch of people money. What we would rather do is sell off all of the equipment and take the money and leave as opposed to pay off the debt holders. You can't do that. You have to pay them before you can distribute the money to yourself and to others. Um, if the firm sort of legally or formally defaults on its debts or files for bankruptcy, then the debt holders actually are entitled to seize control of the company and make management decisions about how to get their money out of it without permission of equity holders. They can actually replace the managers of the company. And so they may themselves then decide to liquidate it, or they may decide to just operate it or change the way that it's run or whatever else and take their money out of it over time. But the key thing there is that the bondholders that or sorry the debt holders now own the company. The equity holders no longer have any rights to the company, and so the debt holders get to decide who manages it, how they manage it, all that sort of stuff. Last kind of thing that I will point out generally about debt is that under U.S. tax code, when a company borrows money and makes interest payments on it, they are allowed to take the interest payments as expenses when they're figuring out how much tax they owe. And so the consequence of this is favorable for a company because imagine that I have a company, and let's just say that as an example, the company has to pay $8,000 in interest expenses at the end of a year. Um, so by paying those expenses and having that reduce their income, let's say that the company, um, you know, has a 25% tax rate, they have basically avoided 25% of $8,000 or $2,000 worth of taxes because they've been able to take this off as an expense. And so their after tax cost is really only the 6% difference. We can calculate that by just taking whatever the interest rate is times 1 minus 25%, 25% being the tax rate. And we would see that our after tax cost is really only 6% because we basically got a tax credit for $2,000 that offset the other $2,000 in interest that we paid. So that's a nice feature of debt, and a lot of times that's one of the things, that plus the fact that the debt holders get paid first, and generally speaking, debt is less expensive than equity as an option for financing a firm, means that the debt is significantly less expensive. So not only is the interest rate, the before tax interest rate, often lower, but because of this tax treatment, the after tax interest rate is also lower, which is the one we really care about. And so that's why a lot of firms would prefer to finance with debt because it's cheaper. So, talk about a couple of different examples of debt that a firm might take. The one that most of you might be familiar with, and that a lot of commercial ventures, particularly small business debt and so forth, is funded through this, is what's called an amortized loan. And that could also be collateralized. We'll kind of talk about that as well. So a loan, as you're probably familiar, is just a negotiated agreement where between the lender and the borrower, they negotiate the terms of how much is going to be lent/borrowed, what interest rate has to be paid for borrowing it, how payments are going to be made back to the lender, and how much has to be repaid and when. So basically all of those terms are negotiated. Now I know for individuals, in your experience, you may not feel like those terms are negotiated in most cases, but they often are, or they can be. And so when somebody, let's say that you're going to buy a car and somebody comes out and offers you and says, we'll loan you the money for that car and here are our terms, you always have the opportunity to shop around for alternatives, or to just simply come back to the dealer and say, I'm not happy with those terms, I want something better, and maybe propose an alternative. So there really is the opportunity for negotiation. And there's definitely that opportunity for negotiation when you're a company. Now, one of the ways that you might negotiate is through this amortization. So an amortized loan is a loan where it's probably what you're most familiar with. Imagine that sort of in the extreme, the possibility of a loan is, I'm going to loan you the money in a commercial loan, and you're going to pay me interest each period, whatever that is, but you're not going to make any payments on the principal amount that you've borrowed until the very end. And so you're going to have one lump sum, or what's sometimes called a balloon payment, at the end. And so as the lender, that means that while I'm getting the interest payments, I'm not getting any of my money repaid until right at the very end. And that can make me very nervous about whether or not you're going to have enough money to make that last big payment. And so the amortized loan is an alternative to this that basically says you're going to make a payment every period that's going to be bigger than just the interest payment. It's going to also include payments against the principal. And so every period when you make your payment, some of that's going to go to pay down how much you owe on the loan. And because by paying that down, you'll owe less in interest in future periods, that means that a bigger portion of that payment can go to paying down principal. And so the benefit for the lender is that they're getting some of that original amount, that principal amount that they loaned, they're getting that back over time. And so they don't have to worry about some one-time big payment at the end and whether or not you're going to be able to make that. Additionally, you will have built up a history, because all of these payments that are made are of the same size, that says that you are able to make a payment of this size consistently. And so it gives a lot more confidence basically to the lender that you're going to perform as it gets closer to the end. And so because of that, the lender is going to perceive that as less risky. Remember that risk is a big factor in interest rates. And so they might offer you a better interest rate. So you might imagine, for example, that you go into a business and you say, what I want to do is I want to borrow $100,000 and I'm going to use that money in my business, and I'll pay you it all back at the end of 10 years. And they'll say, that's great. I'm going to charge you 15% interest on that. And then you say, okay, well, what if I do it instead of a lump sum payment at the end, I do an amortized loan, I pay a little bit of it along the way. And so that term that you offer to them might cause them to say, oh, well, in that case, I may only charge you a 11 or 12% interest rate. So that is one of your negotiating tools, is to amortize. Then there's this last piece. You might also offer collateral. And so with collateral, you as the borrower would basically be adding an additional set of terms that says, if I fail to make a payment, then I am giving you the right to take ownership of some specific asset or set of assets in order to satisfy the loan. And usually the collateral, the value of the assets that you post as collateral, is worth more than the loan itself. And so that gives the lender comfort that says, number one, I always have this fallback that I am legally entitled to, so I'm pretty sure I'm going to get paid. Number two, because the value of that is greater than the value of the loan, that creates a huge incentive for the borrower to make sure that they make the loan payment. And so it motivates the borrower even more to ensure that they make the payments. All of that lowers the lender's risk. And as a result of that, the lender may even lower the rate further and say, oh, well, if you're going to amortize it and collateralize it, maybe I'll only charge you 8%. And so you can see that by offering these terms, you're sort of offering things that are more valuable to the lender, make it less risky to them, and they should respond with better interest rates. Now, I'm just going to give you a quick example of an amortized loan. I know you've seen this in our other projects. But again, imagine that you've borrowed at $100,000 at 10 years, 8% interest. So the idea would be that you're starting out with a $100,000 balance, and you've got to make a payment every year. And we've solved that the payment is $14,902.95. Now, how did I get that? I simply went into Excel, and there is a formula called a payment formula that I used, and that formula lets you put in your interest rate, how many periods that interest rate is for, what the initial amount is, and it will say, oh, in order to pay that off fully, you'll need to make payments of this much per period. You could also get that, if you remember in our time value conversations, we developed a formula for solving for the present value of an annuity. And part of that formula was it said, well, there's the annuity payment, and there's a discount rate, and whether there's a gross rate and all those sorts of things, but basically that's in there. Well, remember that you can rearrange that formula so that instead of solving for the present value of the annuity, which in this case would be our loan amount, you could input the loan amount and the interest rate and solve for the payment that you would be getting for the annuity payment every year. And that would give you this number. And so you can either solve it with that formula or you can solve it through Excel. And so ideally with this, you would start with that $100,000. You'd make the $14,902.95 payment. $8,000 of that's interest, because that's 8% of $100,000 for a year. The other $6,902.95 goes to pay down part of the $100,000 you owe. So that leaves you with only $93,097.05 that you owe starting the beginning of next year. You're going to make another payment, same size. You're going to owe less interest because 8% of $93,097.05 is only $7,448. So because you are paying less interest, that means that more of the payment can go towards principal, and so you're now going from paying $6,902 to $7,455, and you just continue with that process all the way down through the 10th year. And in the 10th year, you have you make that last payment at the end of the 10th year. Hardly any of it's interest because most of the loan's been paid off. Most of it goes to pay off the principal, and you're done. So that's how an amortized loan works. Now, the other way that a corporation might be able to raise money in terms of borrowing money is through something called a corporate bond. A corporate bond is a little bit of a different concept than this sort of negotiated loan that we are most familiar with. A corporate bond is actually a contract. So the firm writes up a contract that says whoever owns this piece of paper is entitled to receive from us a certain amount of money as interest each month, or what they would call a coupon payment, each year, and then in a final maturity payment, let's say 10 years from now, we'll pay them $100,000. And $100,000 is sort of the typical maturity payment, often called the par value of a bond, sometimes called the face value as well. And so literally the owner of this piece of paper, whoever actually holds it, is going to be entitled, they're just going to receive payments from the company. And so when a company wants to borrow money, they issue a collection of these pieces of paper, so they create a stack of them. And so the idea is if they want to raise, say, $1 million or about $1 million, then they might create a stack of 10 or 11 of these things and issue them all at once, and that would be a bond issue. If they wanted to raise $1 billion, then they might do 10 or 11,000 of these and issue them all at once. The reason that it's not exactly 10 is because when they issue them, they are literally putting them out into a marketplace and saying, how much will you pay me for this piece of paper? And so then an investor will look at it, and depending on their perception of the value of that piece of paper, and most importantly, their perception of the risk of the company, they may say, oh, I will pay you $100,000 for it. And by paying $100,000 for it, I'm basically saying I think getting 8% interest rate is a good deal. Or they may say, I think you as a company are riskier than that, and so getting 8% payments is not really enough for me. I need to get more than that, and so I'm not willing to pay $100,000. I'll pay something less than $100,000, and by paying something less, I'm basically still being entitled to $8,000 a year in payments plus $100,000 at the end, but I'm putting up less than $100,000 at the beginning, and so by putting up that less, I'm actually earning a higher rate of return. Okay, and so they may say, you're actually not that risky of a company. 8% sounds like a really good deal, and in fact, it's such a good deal, I'd pay you more than $100,000 to get that piece of paper. In which case, the sort of implied borrowing rate for you is less than 8%, and so the bond is selling at a premium. In all those instances where the transaction is between the investor and you as the company, and so they're giving you money in return for those pieces of paper, we call those primary market transactions because you as the company are one of the parties to the transaction and you are getting the money. Now, once that piece of paper is out in the marketplace, that holder of that piece of paper, what we call the bondholder, they could either just hang on to it and receive the payments that they're entitled to by the piece of paper, or they could sell them off to somebody else and basically say, have somebody else give them an amount of money, and then somebody else is now getting the payments from us. When that kind of a transaction happens, that's called a secondary market transaction because the company doesn't get any cash flows from that, right? Investor one gives the piece of paper to investor two gives money to investor one in return for that piece of paper, and so company's nowhere in that, no cash goes to them, and the company just now starts sending their payments to investor two instead of investor one. So we call that a secondary market transaction because the original issuer, which is the company, is not involved in that. So to give you an example of what that might look like, let's just again take the example of our $100,000 that we want to borrow for 10 years, 8%. So it's all the exact same terms as the other example, the loan example that we did. But in this case, what's happening is we have a starting balance of $100,000. So that's how much money we would say that the company is planning on paying in the future. And they're going to make payments to whoever owns the piece of paper of $8,000 each year, which is 8% of $100,000. And then the last payment is going to be $108,000. $8,000 of it is interest. The other $100,000 is the principal. And so you can kind of see how that adds up. And so at the end, they've paid off really the principal throughout, but none of the interest throughout, but none of the principal. And they make that payment at the end, that last principal payment, to pay everything off. So it is that balloon type of payment that we were talking about before. Okay, and that's sort of a typical corporate bond. Now, if we want to kind of compare between those two, again, you can see you're starting out with $100,000 that you are committed to pay to somebody, and that it has to all be paid off by the end of year 10. Difference is with the commercial loan, you're paying some of it off a little along the way, which is also reducing the total amount of interest that you pay along the way, versus with the bond, you're paying the full interest all the time, and at the end you have to come up with all $100,000. So as we've talked about before, the factors that really affect interest rates in general are the real rate and the inflation rate. With bonds, there's also this interest risk premium. The interest risk premium simply reflects the fact that what the market expects as a rate of return, a fair return for inflation and the real rate, for example, over time. It varies over time. And to give you some idea of that, right now, sort of the real rate plus inflation premium on a 1 month bond is very, very low. It's like 0.25%. Whereas there was a time back in the early 1980s where that same 1 month bond was earning over 10%. And so if you're somebody that has locked into a deal to receive 0.25% return, and you're looking around and everybody else is receiving 10%, you feel a little bit like a fool, and that you should be getting more money for that. And so you've been harmed. You have kind of a loss of value because you're not getting a high enough rate. And so the fact that interest rates vary a lot over time, these inflation and real rates vary over time, means that the longer the term, the longer the number of months to maturity on a bond, generally speaking, the higher the interest rate's going to be, because it reflects the fact that you are more exposed to the possibility that while you're holding the bond, the market may decide that you should be entitled to a higher return than what you're getting right now. And so, for example, with a 360-month bond right now, which is a 30-year bond, basically, the interest rate on a 30-year bond is almost 2.25% as opposed to just 0.25%. That extra 2% is compensating the investor in that bond for the risk that interest rates may go up and sort of harm the value of their investment during this time. Now, the other thing that goes into this, and probably the more important thing for corporate bonds, is the risk of a default. And so, again, the first risk was the risk that interest rates would change. This is the risk that you as a company might not be able to pay back your loan. And as you can imagine, the longer that I have to wait for you to pay that back, the more chance there is that something bad could happen to your company and make it harder for you to pay it back. So the longer the time period that you borrow on the loan, the more risky I perceive the loan to be. And so, for example, for sort of a typical risk corporate bond right now, a 30-year bond from a company might have to pay 4 or 5%, even though taking into consideration sort of all the other risks, for a bond that there's no risk of default, the rate may be less than 2.5%. So that extra premium is purely to compensate for concerns that you as a company might go bankrupt or in some other way not be able to make all of your payments. Okay, and again, you can see that that premium gets wider over time. So the difference between the risk-free rate and the risky rate gets wider as the number of months that you have to wait before you as a lender have to wait before you receive your money gets longer. That gets wider to reflect the fact that there's just that much more time for something bad to happen. Okay, so kind of that's the base understanding, if you will, of cost of debt. Here's the deal, though. You need to be able to figure out for your company what your cost of debt is. Well, if you are just going to a bank or a lender and negotiating a loan, then there's not much for you to figure out. You and the lender will go back and forth and agree on an interest rate, and that will be the cost of your debt. However, for a bond, what you have built into the contract is not your interest rate. It's just a coupon payment. And so what you have to do is basically, based on the price that the bond is selling for, figure out, think of that price as being what people are saying is the present value of the bond. So you've got the present value of the bond is whatever it's going for in the market today. The future payments on the bond are the coupon payments and the maturity payment that are specified in your contract or your piece of paper, right? And you have to solve for what interest rate equates those future payments back to that present value. So what discount rate would you discount those future payments back in order to get to that same present value? And so I'm going to give you a quick example of that. So for example, with our bond, if we just assume that we've got the cash flows here, right? And we've assumed a discount rate of 8%. I've just sort of plugged that in, okay? And so at 8%, if I were to discount all of these payments back to 8% and take their present values, so this is just the discount rate. So here, this is simply 1 divided by 1 plus 8% raised to the first power, 1 divided by 1 plus 8% raised to the second power. So that's what I call a discount factor. So if we take the cash flows, multiply by the discount factor, we get their present value of each cash flow. So here's the discounted or present value of all of these future cash flows. If we sum them all up, which I've done here, they come up to $100,000. And that's because the discount rate equals the coupon rate, okay? But let's say that we felt like that this bond was more risky and maybe deserved a 9% rate. We put that in there. We solve back for the present value of these payments at 9%. We would say that the bond's only worth $93,582.34. And so that bond is selling at a discount because it's selling for less than the $100,000 face value of the bond. And it's doing that because it's riskier, and so requires a rate of return that's higher than the 8% implied by the coupon payments, okay? Or we could say, well, maybe it's not such a risky company and maybe 8% is too high. 7 seems reasonable. So I'd put that in there. And if we take the present value of all these payments at 7% and sum them together, winds up to be $170,023.58. And so it's selling for more than the $100,000 face value. It's called a premium bond. All right. And it's a premium bond because the implied interest rate, the 8% interest rate that's implied by the coupon payments, is higher than what the market thinks is a fair rate that should be charged for a loan to a company with this level of risk. And again, it could be the riskiness changes. It could just be that the real rate in the market has changed and people don't think that they need as much money. Could be that the inflation expectations have gone down. Could be that the uncertainty about interest rate fluctuations has changed. Or it could be that your default risk, your perceived likelihood of defaulting on the loan has gone down. Could be some combination of those. So because it's all those different things that investors are taking into consideration, it could just be that an investor comes along and says, I like that cash flow, and in return for that cash flow, I'm willing to pay about $107,000, okay? Now, your problem is you don't have the percentage. What you have is what the thing's selling in the market for today. And so what you have to do is solve for the percentage. So what I've done is just take the calculator, if you will, that we had before that solves for present value, and now let's just stick in a current price number. All right? And what we want to do, let's just pick a price. Let's start with the $100,000. Okay, so it's $100,000. And so I'm taking the difference between what we're solving for as present value and whatever its current price is. I want to make those two values equal. And so the difference between them, the premium or discount, should be 0. So I'm going to use goal seek in Excel to do that. So we're going to go data. Wait a minute, did that wrong. Data, what if analysis. It's in different places for different versions of Excel, but goal seek. And I'm going to set this premium discount cell equal to 0 by changing the discount rate. It's going to solve back and say, oh, we get to a 0 if you're saying that you're currently willing to pay, the price is $100,000 in the market. That's what people are willing to pay for this. Then they're going to say that's the equivalent of a 8% interest rate approximately. And so basically going to say to you that, at 8% That is what the market thinks a fair interest rate for lending to you would be based on the bond value. Now, let's just say that the market was selling it at call it $94,000. Did I get that right? Yeah. So right now it's selling at 94,000. You want to go through the same process to say, okay, well, we're going to set the difference to 0 by changing the discount rate, and it's going to come back and say, oh, well, $94,000 is a price that is consistent with an 8.93% discount rate. And so basically is saying that your cost of capital, if you wanted to go out and issue more bonds, you should expect that it's going to cost you about 8.93% to issue those bonds. Okay? Again, the market could be selling at 110,000. See if I did that right. Yeah. Go through the same process. Goal seek, set that difference to 0 by changing the interest rate. Now, what do you expect is going to happen here? My argument would be that because the current price is higher than $100,000, that must mean that people like this coupon payment more than a lot, and so they are happy with an $8,000 coupon payment because they would be satisfied with a lower interest rate than 8%. And so we would expect that this would solve for an interest rate that's below 8%. And for whatever reason, it comes up as 6.6%. Okay, so the market rate, what they would be happy with for your company at this point is 6.6%. And so they're going to be willing to pay you extra money in order to make that happen. All right. So at this point, what we've done is basically gone through and give you an example of how you would solve for the before tax cost of that debt if you just knew what the bond was selling for and you knew kind of what the coupon payments and all that were. Remember that at some point you're going to want to adjust that to its after-tax cost of debt. So you're going to take that rate and multiply it by 1 plus or 1 minus whatever the tax rate is. And that's it on bonds. I know that's it's a little bit of math, a little bit confusing, but hopefully you'll be able to sort of follow the logic on this. Thank you.